Stop before you make any property decisions in 2025. You need to see this data. For the first time in 4 years, all 8 Australian capital cities are growing simultaneously. The national median just hit $1.2 million. Interest rates dropped to 3.60% and one city saw $23,000 of price jump in 90 days. I am about to show you the actual numbers from the big 4 banks, KPMG and the Reserve Bank. Not property spookers' promises, just facts. If you're thinking about buying your first home or making an investment in 2025, the next 12 minutes will save you from the expensive mistakes. Hi, I'm Rajan Sharma and I analyze property data full time. And frankly, most of what you see in the media about Australian property is either outdated, biased or plain wrong. Today's data comes from Commonwealth Bank, Westpac, NAB, ANZ plus KPMG economic reports and Reserve Bank statistics. No opinions, no predictions, just what's actually happening right now. You will get the real growth numbers for Sydney, Melbourne and Brisbane, the specific opportunities that exist today, the risks no one talks about, and most importantly, what this means for your money. This isn't about getting rich quick. This is about understanding markets so you can make informed decisions. Sydney. Let's start with what's actually happening, not what people think is happening. Current median house price is $1.5 million. Annual growth is 2.2% for houses. Monthly growth is approximately around 0.8%. Here is the context most people miss. Sydney house prices grew 3.3% year to date. That's $50,000 in actual dollar terms on the median house. Why is this happening? 3 measurable factors. Factor 1 is supply. Listings are 20% below the 5-year average. That's not an opinion. That's counted properties for sale. Factor 2 is demand. Auction clearance rates at 71%. That indicates stronger buyer competition. Factor 3 is rate sensitivity. When the Reserve Bank cut rates to 3.60% in August, Sydney responded immediately because higher price properties are more sensitive to rate changes. Here is what the major banks forecast for Sydney's remaining 2025. Commonwealth Bank expects 5% total growth. ANZ expects 4.6% total growth. NAB expects 2.7% total growth. Westpac expects 3% total growth. Banks expect Sydney to continue growing, but at moderate rates. The explosive growth phase is over. Current conditions favor people already in the market looking to upgrade. For investors, rental yields in Sydney average around 2.5 to 3.5%. You are buying for capital growth, not cash flow. Vacancy rates at 1.5% mean strong rental demand, but purchase prices require significant capital. For first-time buyers, the median house price requires roughly around 305k deposit plus stamp duty. That's the mathematical reality of Sydney entry. Melbourne. Here is the comeback story in numbers. 2024 was rough for Melbourne. Prices actually declined in several months, but 2025 shows a clear reversal with 4 consecutive months of growth. Current position shows median house price at 1.06 million. Annual growth is around 2.1%, but here is the important number. $23,000 of quarterly increase. That's the sharpest 90-day gain in 3.5 years. What changed? 3 measurable factors. 1. Inventory dropped. New listings down 11.2% compared to last year. Total listings down 15%. Less supply creates more competition. 2. Sales velocity increased. Median time to sell is 37 days. When properties move quickly, it indicates genuine buyer demand. 3. Sales volumes jumped 8% year on year. More transactions mean more market confidence. Major bank forecasts for Melbourne 2025 show Commonwealth Bank expecting 5% growth. ANZ expects 4.1% growth and NAB expects 2.3% growth. Westpac expects 3% growth for 2025, but they have upgraded 2026 to 10%. What this means is Melbourne is playing catch up after 2024's poor performance. Current prices are below the peaks of 2022, creating a relatively more valuable opportunity compared to Sydney. For investors, Melbourne offers better rental yields than Sydney, typically 3.5 to 4.5%. The recovery creates potential for both rental income and capital growth. For first-time buyers, Melbourne's median requires approximately around 210k deposit plus costs, more accessible than Sydney with similar infrastructure and job markets. The risk is that Melbourne's growth is recovery-based, not fundamental demand. If economic conditions change, recovery-based growth can reverse faster than demand-driven growth. Brisbane. This is where the real growth is happening. Current facts show 6.7% annual growth, 0.7% monthly growth. Median house price is around $1 million. Brisbane isn't just leading, it's dominating. While Sydney grew 2.2% and Melbourne 2.1%, Brisbane grew 6.7%. That's triple the growth rate. Four measurable factors driving this. One is population growth. Interstate migration data shows consistent movement from Sydney and Melbourne to Brisbane. Two is infrastructure spending. Cross River Rail costs $7.1 billion. Brisbane Metro costs $2.2 billion. Queen's Wharf costs $3.6 billion. That's $12.9 billion in current projects. Three is supply constraints. Vacancy rates below 1% in many suburbs. New dwelling approvals haven't kept pace with population growth. Four is the Olympic effect. The 2032 Olympics create a 7-year infrastructure and development timeline that's already begun. Major banks' forecasts for Brisbane 2025 show Commonwealth Bank expecting 8% growth, the highest of any capital. ANZ expects 7.4% growth. NAB expects around 5.9% growth, and Westpac expects 3% growth. For investors, Brisbane offers the best combination: 6.7% capital growth plus rental yields of 4.5 to 5.2%. That's potential total returns of 11 to 12% annually. Rental market facts show vacancy rates below 1% create landlord-favored conditions. Median apartment rents increased 15% in the past year. Supply shortage continues. For first-home buyers, Brisbane's median requires approximately around 204k deposit, similar to Melbourne, but with strong growth prospects. The risk is that Brisbane's growth is the strongest, but it also had the biggest run-up. Prices have increased over 50% since COVID. Growth rates this high typically moderate over time. Based on this data, here are the factual opportunities available right now. Opportunity 1 is the interest rate cycle. The Reserve Bank cut rates to 3.60% and major banks forecast further cuts to 3.1 to 3.35% by end of 2025. Mathematical impact shows each 0.25% rate cut saves approximately $150 monthly on a $1 million mortgage. That's $1,800 annually or additional borrowing capacity of roughly $30,000. Opportunity 2 is supply constraints. National listings are 20% below 5-year average. New dwelling production is forecast to decline 11% in 2025. Economic reality shows when supply drops and demand remains steady, prices increase. This isn't speculation, it's basic market mechanics. Opportunity 3 is rental income growth. Median apartment rents are projected to grow 24% between 2025 and 2030. That's 4.8% annually. For investors, strong rental growth provides both cash flow and forces some renters into purchasing, increasing buyer demand. Opportunity 4 is infrastructure investment. Brisbane's $12.9 billion in projects. Melbourne's suburban rail loop. Sydney's metro expansions. Infrastructure spending historically increases surrounding property values. Where to focus based on data shows growth seekers should consider Brisbane, which offers highest capital appreciation potential. Value seekers should look at Melbourne's recovery, which creates relative value versus Sydney. Stability seekers should consider Sydney, which offers predictable moderate growth. Cash flow seekers should focus on Brisbane, which provides best rental yields. Now, the risks. Because every opportunity has a downside and you need to know both. Risk 1 is affordability ceiling. Current data shows mortgage repayments require 47.7% of median family income. Historical data shows markets stall when this exceeds 50%. Reality is, if incomes don't rise with prices, buyer demand eventually drops. This is mathematical, not emotional. Risk 2 is interest rate reversal. While rates are falling now, they can rise. If inflation returns or economic conditions change, the Reserve Bank will raise rates. Impact shows each 1% rate increase reduces borrowing capacity by approximately 10%. A return to 5% interest rates would significantly impact buyer demand. Risk 3 is economic downturn. Current growth assumes continued economic stability. Unemployment, global recession, or major economic shocks can quickly change market conditions. Historical fact shows property markets are cyclical. No market grows indefinitely without corrections. Risk 4 is supply response. If prices continue rising, developers will eventually increase supply. Large amounts of new supply can moderate or reverse price growth. Brisbane risk shows growth rates of 6.7% annually are historically high and typically moderate over time. Melbourne risk shows recovery-based growth can reverse if economic conditions deteriorate. Sydney risk shows high prices make the market vulnerable to affordability constraints and rate increases. Here is the expert analysis analysis that matters. KPMG upgraded their national forecast from 3.3% to 4.9% growth for 2025. This represents increased confidence in market fundamentals. When conservative forecasters like KPMG increase predictions by 1.6% points, it indicates genuine data-driven optimism. Current situation shows all 8 capitals growing simultaneously for the first time since 2021. The broad-based growth suggests national economic factors rather than city-specific bubbles. Market reality shows 77 suburbs have doubled from $500,000 to $1 million in the past decade. Analysis shows these were typically outer ring suburbs with infrastructure development. Pattern recognition shows suburbs 20 to 40 kilometers from CBD with planned transport links consistently outperformed. This pattern continues with current infrastructure projects. The current national median is $1.098 million, up 4.6% annually, but city by city variation ranges from 2% to 8% growth. Investment implications show national averages hide significant regional opportunities. Success requires city and suburb specific analysis. The data shows Australian property markets are experiencing a synchronized upturn driven by interest rate cuts, supply constraints, and infrastructure spending. However, affordability constraints and cyclical factors suggest growth rates will moderate over time. Current conditions favor buyers with sufficient capital and investors seeking rental yield plus capital growth. First-time buyers face challenges in Sydney and Melbourne but have opportunities in Brisbane and selected suburbs. Here is what the data tells us. Brisbane leads with 6.7% annual growth driven by infrastructure spending, interstate migration, and Olympic preparation. Best opportunity for growth and rental yield. Melbourne is recovering with 4 consecutive months of gains and $23,585 quarterly increases. Offers relative value compared to Sydney with similar economic fundamentals. Sydney remains stable at 2.2% annual growth, responsive to interest rate changes, expensive but predictable for those already in the market. The opportunity shows interest rates falling, supply constrained infrastructure spending continues. The risk shows affordability limits, economic uncertainty, markets are cyclical. Make decisions based on your financial position, not market timing. Property market rewards patient investment over speculation. Which cities' data surprise you? Are you planning to act off any of these trends? Comment below. I respond to genuine questions. If you found this video valuable, don't forget to subscribe to my channel and hit that notification bell. See you in the next video.